Um, Morning everyone. Welcome back to Morning Kappa at 8. I'm Joseph here. Looking at the Hang Seng Index, the index have a very strong rebound all over the Friday. Right? However, the index are still below the 20 days and 50 days moving average. Overall, technical setup remains bearish so far. And over the week, the Hong Kong market experienced strong selling pressure. Only the banking stocks and also a handful of tech stocks have bucking the trend, especially the China Constructions Bank and as well as NetEase 9999, right? And as for the Hong Kong trading stocks, firstly we look at the China Construction Bank, which break past 8 Hong Kong dollar 80 cents, heading towards 930 and followed by 980. Downside support is 840, and then on NetEase, um, Wang Yi, right, have break past 195, heading towards R1 205 and followed by 215. Downside support is 185. And as for the China A50 futures, it have managed to climb above the 20 and 50 days moving average, showing that the selling pressure on the big cap stocks in China have see the bullish momentum re-accelerate. So in the China market, I'll be looking at firstly the 002371, which lists in the Shenzhen stock market. Stock code is the Chinese name is called Beifang Huachuang. Right, it have break past the 600 renminbi, heading towards 700 and followed by 750 renminbi. And that support is 615 renminbi. Okay, and now over the this morning, right, we saw one news that affect the oil market, which is the Iran and US. Accordingly, they have reached an agreement, and according to a Trump posting, I mentioned that this coming Friday, so the Hormuz is going to reopen. I think that news is going to give a negative price actions on the WTI. Um, at this juncture, we have a short positions on the WTI, and we're looking at 80, perhaps at deeper corrections towards 70 US dollar. Meanwhile, the gold price have staged a rebound on the Friday sessions, eyeing to climb above 4,004 this week. So we stick bearish bias on the gold until it break past 4,004 threshold. Now, meanwhile, S&P 500 have rebound on the Friday night, right? As I mentioned before, right? Once the SpaceX IPO coming to close, money is going back to the market again. Now, this juncture, SpaceX is not included in the S&P 500 due to earnings, lacking of earnings, but it's actually into the Russell 2000. So for S&P 500, upside resistance is 7,005, followed by 7,750. Downside support is 7,003. Right. At this juncture, keep a bullish bias on the S&P 500, and I'll be looking at the tech stocks today. Firstly, the Teradyne, which break past 400 US dollar, heading towards 450 and followed by 500, and downside support is 355. Secondly, we have Apply Mat AMAT, which have break past 550, heading towards 620 and followed by 680. Downside support is 480. So we have two US tech stock here, Teradyne, which serve the semiconductor by producing the automated machines, and also the Applied Materials who are building the equipment for the front end semiconductor player. Now then on Malaysia's FBM KLCI remains on a consolidation mode over the week. This for now, I can see that the index is below the 20-week SMA line, showing that corrections are in play. Right, last week, only Plantation and Transportations are recorded in positive territory. Now, meanwhile, healthcare, energy, property have experienced a strong selling pressure last week. So we'll keep a bearish bias on the FKI until it break past 1720, right? And as for the FPO, right, on the Friday, it still experience selling pressure, and we keep our stop loss point at 4,007 right now. Now, as for the trading stocks, firstly, we'll be looking at DNEX, Dagan Exchange. We break past the 35 cents resistance on the back of a strong volume. So DNEX should be climbing towards 38 cents and followed by 41 cents. Downside support is 32 cents half. Then on we have critical holdings break past eyeing to break past the 1 ringgit and 13 cents. On the upside, first resistance at 1 ringgit and 20 cents and followed by R2 1 ringgit and 28 cents. Downside support is 1 ringgit and 5 cents. So we have one breakout stocks, Data and Exchange. Now DNEX have two business. Firstly, they are in the semiconductor wafer fabrications. They also owned a stake in the oil and gas productions company. So DNEX have a breakout, and then critical holdings. They are in the business of maintaining the MEP, mechanical engineering on the production facility at the data center. So critical holdings is eyeing to stage a breakout, testing the 1 ringgit and 13 cents resistance. So we have these two stocks for the Malaysia market this morning. I'll stop here and pass on to Sian on the Rasa Mingguan report. Thank you.
Thanks, Joseph. So good morning, everyone. Please let me to share my screen now. Okay. Hold on. Okay. I hope you can see my screen. So as what we actually presented in our last week Rasa report, so we do see that the RHB risk sentiment index actually has plummeted to risk neutral zone. So as indicated by the blue line here, with the US equities slated to follow on the back of higher risk premium as well. So as what we see last Friday, so this is also signal that investors are actually spoke over the recent conflict escalation in the Middle East as well. However, this morning there are some positive news actually coming out in as what we see from the news, where US and Iran has actually reached an interim agreement to reopen the Straits of Hormuz, so halting Straits of Hormuz as well, where the officials from these two countries will actually meet in Switzerland formally to sign the agreement as well. So and then however, as what we see last week, so we still seeing that conviction for the investors to actually stay defensive actually play out nicely, with the MSCI actually plummeted 4% since the 2nd June's peak as well. So key sentiment determinants will still center on geopolitical premiums, and also now apparent by last Friday's interim recovery amid US President Trump's claim that US-Iran deal is near. So I think one of the very key important event will be the upcoming meeting between these two countries, US and Iran as well, in Switzerland. So in the market, so global fund flows continue to underlie actually softer risk appetite seen from a reduction in equity exposure, while bond demands still stay supported for now. Sell-off in China assets have eased, and then but further decline in global equity flows may still be possible should the risk appetite weakens further into this new week. So over the last week, we have also include some of our views on the central bank move across the globe, across the major economies. So where we are seeing that the FOMC and also BOE will likely to stay pat on 18 June, but Bank of Japan may hike 25 basis point to around 1% on 16 June. So ECB may hike again on 23rd July. So in ASEAN, we also seeing that Bank Indonesia may hike again on 18 June to actually bring its reference rate to 5.75%. So our modified, meanwhile, from the US end, so our modified Taylor's rule do suggest that FFR will likely to stay pat for 2026 and will likely to see two more 25 basis point cut by 2027. So, and then meanwhile, so ECB might hike, but more ECB may hike, but more may still be on the cuts. So Bloomberg News too reported that so ECB officials are not ruling out another rate hike as soon as next meeting on 23rd July as well. So, and then meanwhile, for BI, so we do see that may hike again next week. So this week after its off cycle 25 basis point hike last week. So IDR remains soft despite with 10-year yield surging to 7.45, suggesting continued fund flows as well. So on BOJ, inflation is likely to accelerate further while core prices to remain hot, so thus necessitating a hike to ensure a stable prices as well. So closer to home, so last week we have also the release of IPI for Malaysia, IPI data for Malaysia for the month of April. So as expected, the IPI for the April is actually quite strong, where it surged by 8.2%. So this is also in tandem with a strong export print, which was released earlier on, where the export actually accelerated more than 30% in April as well. So the prints for April IPI is stronger than March period of 3.1%, but slightly below our in-house projection of 9% and well above the Bloomberg consensus estimate of 4.5%. So stronger than expected growth was driven by broad-based growth across all the sectors, especially with the manufacturing actually accelerating by 8.3%, so supporting by a continued resilience in some of the key sectors, such as E&E and also petroleum related products as well. So meanwhile, we have also revised our 2026 industrial production index growth forecast upward to 4.9%. So versus our former estimates of 4.1%. So revision is also predicated on robust year-to-date IPI growth of around 5% for the first 4 months of the year. So underpinned by a stronger than expected expansion in April, continued resilience in E&E exports, and firm domestic demand. So for the rest of the year, so we do see that manufacturing sector will be supported by sustained global E&E demand, steady domestic consumption, and also targeted policy measures. If there is an easing of the US and also Iran tension, so we think that it will even be more supportive for the global growth and hence Malaysia's exports and also manufacturing sector outlook as well for this year. So we still remain vigilant regarding the external risks for now, including the ongoing and also lingering uncertainties in the Middle East tensions, potential shift in the US tariff policies, and also rising production cost pressure, as reflected in the sharp acceleration of the PPI, alongside with the moderation of the manufacturing PMI recently. So that's all from me. I'll pass the stage to the next presenter. Thank you.
Hi, good morning. Today we've got a report on the plantation sector. So basically we are upgrading the sector to overweight from neutral, or rather we technically positive. If you recall, we were technically positive before this, but now we are fundamentally overweight. And this is because the US National Oceanic Atmospheric Association, or rather the NOAA, has announced that El Nino is here, and they've confirmed it and issued an El Nino advisory. They're predicting El Nino to intensify to a moderate or strong level, but the strength of the El Nino has yet to be confirmed. Right now, the probability of a strong El Nino peaks at 88% for the November 2026 to January 2027 period. So if there is a strong El Nino and if it does occur, then we would see palm oil output being affected negatively, where the impact can last for as long as 2 years, depending on the severity. If you recall, we talked about the fact that a significant impact on CPO yields from El Nino would only really be felt during very strong El Nino periods. We also highlight that the Australian Bureau of Meteorology, which is the other forecaster that we usually look at, has yet to declare a confirmed El Nino. So historically, El Nino usually results in a yield drop of between 2 and 20%. If you look at the historical last 2 strong El Nino periods of 1997 and 1998 and 2015 to 2016, there was a 17% drop and a 14% drop in CPO yields 1 year after the El Nino. So basically, if you look at CPO prices as well, average CPO prices rose by as much as 21% during the El Nino years and by an additional average of 26% 1 year after El Nino. So while we are keeping our CPO price forecast for now, pending confirmation of the strength of that El Nino, we do believe that there is obviously upside risk to our CPO price assumptions. more so for 2027, where we have a lower CPO price than this year. So this year, our price assumption is 4,004. Next year is at 4,003. So next year's price is there is a risk, upside risk there, especially given the fact that CPO prices would normally rise instead of fall the year after the El Nino, especially if it is a strong event. The other upside risk to CPO prices would also be the impact of Indonesia's Natural Resources Export Governance Scheme, where Indonesia wants to channel all export transactions through Danantara Sumberdaya Indonesia. Although obviously we have heard news that the Indonesian government is thinking about scaling back the scheme, but we understand that even with the scale back, there will still be tighter monitoring of exports as well as a pricing methodology set for export prices. And all this is aimed at curbing suspected under invoicing and transfer pricing. So in terms of timeline, it was supposed to be implemented from the 1st of June, but I think there is a transition period right now in terms of the phases that they're going through. The first phase is a transition period between 1st June until end of September. And then the second phase is where it will be implemented, and the hard deadline is 31st of December 2026. So with this, exporters will have to do a lot more paperwork, submit monthly reports, and keep all their details of the exports with the government, and the government will be doing the exports on their behalf. So what we think will happen will be that there will be some front loading of exports out of Indonesia in the initial transition phase. But once implemented, what we could potentially see is delays of exports coming out of Indonesia, leading to tighter supply and therefore higher prices. We could also see Indonesian planters, facing higher costs, and that is related to this extra monitoring. But again, as what we normally see, we would normally see CPO prices also rise to offset this risk. I think what we have seen since Indonesia has announced this scheme is that share prices of the regional planters have actually corrected significantly of late. So you will notice from our report that some of the share prices, especially the regional share prices, the stock calls are a little bit out of whack at the moment. So our stock calls are definitely under review at this point. But as I said, we've upgraded to overweight. Our top picks are unchanged, where we still like Johor Plant, Sarawak All Palms, IOI Corp, and the new one that we initiated on Friday, Hapsing Plantations, and STK3 in Malaysia, as well as London Sumatra in Indonesia. So let me stop here and pass you on to Max. Thank you very much.
Right, thank you, Leng. So we have a energy sector results report. This is for the first quarter 2026 earnings. So the sector earnings were largely in line, where out of the 9 companies under coverage, 4 came within expectations, 4 had outperformed, which are mainly the solar names, whereas 1 actually fell below expectations. In particular, for this quarter, the solar names that we cover, meaning SolarVest, Simodent, as well as BM Greentech, earnings actually had beat expectations. This is mainly due to better margins, as well as stronger order book recognition. Among the big cap utility names, Tenaga earnings were in line. This is largely driven by a 7% demand growth in terms of electricity sales, which helped to mitigate that sort of a high 31% effective tax rate. Petronas Gas and Malakoff earnings also were in line, largely because of the improving or normalization of operations at their coal plants. For YTL Power was the only earnings that came below expectations, mainly due to higher losses at Telco. But on the flip side, we have also seen the contributions from the data centers has improved. And in the coming quarters, we do expect the capacity of data centers to increase to about 288 megawatts by the end of FY27, which is June next year. Moving forward, for Tenaga, we expect the earnings to improve as they start to recognize more of their investment allowance, which will help to reduce their effective tax rate. And they're also on track to meet their 13 billion capex utilization for this year. We also expect Malakoff earnings to also improve on operations recovery at their Tanjung Bin Power. So all in, we do maintain our overweights call on the sector. Tenaga is still our topic as the prime beneficiary of the energy transition roadmap. Whereas we also advise clients to accumulate SolarVest and Simerdon, given the recent share price correction, and we do expect the order book recognition to continue to sustain. And given that the electricity tariffs is expected to increase in the coming months due to the high energy prices, we do think that there might be a more accelerated or gradual shift towards the adoption of solar tap or your rooftop solar installation within the residential as well as the commercial and industrial segment as well. So all in, we maintain our overweight on the sector, and these are the names that we recommend clients to buy. So that's all today that we have for IMNC. Happy trading, and we'll see you again tomorrow morning. Bye-bye.